Your money, your business. This is Financial Poise Radio, the spoken word sister of FinancialPoise.com.
Hello, everyone, and welcome to Financial Poise Radio. I am Christopher Cahill, and in a few minutes, I'll be speaking with Larry Swedroe, the Director of Research and Board Member at Buckingham Asset Management and BAM Advisor Services. BAM being the acronym for Buckingham Asset Management, so BAM Advisor Services. Well, Larry has written or co-written 7 books. He has a gift for distilling the most important academic research on investing into cogent features of an investment context usable for non-specialist investors, non-academics. This time he'll explain how Buffett has been winning his bet against hedge funds as far as year-on-year performance over a number of years. By Buffett, of course, we mean Warren Buffett of Berkshire Hathaway fame. But a few comments on relevant recent writings. Net. Investment property without the hassle. That's the name of a column on Financial Poise. Find it on financialpoise.com. by Tracy Trieger. Tracy Trieger is a regular columnist, and her regular column falls under the heading of location, location, location. Ms. Trieger speaks in threes on occasion. Well, the 3 is appropriate here because her net leases. What in the world could that mean? Well, I'll let you read the article. But the overall point is triple net leases relieve the owner of many of the obligations that your college landlord had, for example. If pipe burst in the middle of the night and it's 14 degrees below zero, if you went to college where I went to college, you might have experienced something like that. You call the landlord, the owner, and the owner has to deal with it. Well, with a triple net lease, you very likely, as owner, would not have to deal with that. The tenant, usually a commercial tenant, will be the one worrying about a pipe bursting in the wall in sub-zero conditions. In other words, you have a better predictability and less anxiety with regard to your real estate investment. But again, why not be instructed by Tracy Trieger, who knows 20 times as much about that than yours truly? Another article, and this one's on accreditedinvestormarkets.com, AIMKTS.com, which is a site affiliated with financialpoise.com and accessible from financialpoise.com, and used to be the host of this show. Anyway, has a really, I think, unusually fine article by Brian Thopsey, and it's entitled Ranking Top Angel and Venture Capital Fund Managers, Part 1, part of a larger project, and it's an ambitious project. Now, those who listen to this program have heard me complain. Maybe the proper word is kvetch, maybe it's a different word, about financial journalism. So much is entirely superficial. And in this article, Mr. Thopsey looks at rankings that financial journalism offers for who are the top 10 angel investors, who are the top 10 venture capital investors, private equity funds, hedge funds. So they're rankings, and that's good. If people are interested in these sorts of investment modes, might be interested in who the superstars are, who the celebrities are, in the sense of investment celebrities. But if you step back for a moment and think, there are all kinds of top 10 lists out there, and many of them are simply and only clickbait. Top 10 actors from Oklahoma. Top 10 reasons men and women don't like each other, and so forth. These are quite literally best regarded as BS because they have no relationship to any kind of truthful concept of evaluating one thing more than another or any kind of reasonable measurement device. They're just clickbait. Well, you'd like financial journalism to be less like clickbait and more like something that genuinely measures something. And Mr. Thopsey, to his great credit, analyzes various rankings and evaluation methods used by the following journalistic outlets. And these were outlets that ranked angels, VCs, PEs, and hedge funds, and so forth. CB Insights, Matramark, Bison, Forbes, Fund Wisdom, Preqin, Bloomberg, Barron's, and Zero Hedge. They all had rankings. And Topsy asked some of the right questions about how to regard these rankings or how these rankings were put together. I note that the CB Insights ranking of top 10 angel investors, number 10 is Ashton Kutcher, who I understand him to be an actor of some kind. Speaking of clickbait. Well, anyway, a social scientist takes very careful aim at understanding public opinion, will develop a public opinion poll in which the questions are intended to elicit the attitudes held by people, by contrast to questions intended to elicit emotional reactions. You can imagine a very inflammatory public opinion polling question, as opposed to one that's more carefully and responsibly and neutrally cast. Well, the answer to that question is going to measure an attitude. If it's the latter, it's going to measure a reaction if it's the former. And if it's a public opinion poll is measuring actual attitudes held by people based on some level of knowledge, then they're considered to be more valid. They have more validity. They're measuring something genuine. They're measuring what they purport to measure. Related to that, a social scientist will worry about the reliability of the measurement device that he's employing or she's employing. If this question is asked of a sample from the same population a few hours after it was asked the first time, will the findings be reasonably similar? Will they be reliable? Are they repeatable in that sense? So when you look at clickbait, the BS meter goes up to 100 because there's nothing valid and nothing reliable about the rankings of clickbait. And Mr. Thopsy, again, begins the process, very admirable process of separating wheat from chaff when it comes to ranking angels, VCs, PEs, and hedge funds, which is consequential. We are all babes in the woods, basically, when we're regarding these superstars we read about in the financial press. Are we to follow their methods? Are we to try to learn from them? Well, looking at a ranking might lead us to do one or the other. Mr. Thopsy is doing a public service by helping us decide what is truth and what is BS when it comes to ranking. And I can't leave the topic and get us to Mr. Swedroe without presenting to you a very short article. You have to read the paper carefully to find it, from the August 12, 2016 Wall Street Journal. It's entitled Economist's Big Fishtail Misses Mark. And it's about Camp Kotok, K-O-T-O-K, which is located somewhere in Maine. It's actually an annual event organized by David Kotok, who is the chief investment officer at a large investment firm. At this camp are eminent economists. So Mr. Kotok is able to bring a large group of eminent economists together for fishing and camping and talking about things of common interest to them. Well, what the article is concerned with is a betting pool, an annual betting pool, this annual event, in which the eminent economists predict things, predict economic indicators for the following year. So in 2016, the betting pool looked at what 2015 groups at the camp predicted. And here's what we found, and I'm going to both read and comment, so it's not exactly what was written here. I have to do that in order to make it clear. Among the notable misses of this predicting group in 2015 was the average forecast for the 10-year Treasury note yield at the end of July 2016. In 2015, the group predicted it would be 2.3% 10-year Treasury note yield. Well, what happened over that year was a 0.45% 5% Treasury note yield. They overpredicted the level of the Treasury note yield by a factor of 5 by my math. The group also in 2015 predicted the yen-dollar exchange rate would be 128. In fact, it turned out to be 102, which means they were off by roughly a quarter, 25%. Well, okay, everybody makes mistakes. Yes, but not everybody speaks with the authority of eminent economists or famous journalists who lap up the words of eminent economists and then regurgitate them onto the page for you to get you excited or to get you to adopt their views. Not the same as clickbait, but how far away is it? I guess is one way, a rather dark way of characterizing the worst of the financial journalists. Well, this reminds me that some months ago on this show, I talked about A. Philip Tetlock and Dan Gardner and their work on super forecasters. These are social scientists who themselves are very concerned with reliability and validity, how to measure and what to measure and whether you're measuring something real. And they compared the forecasting abilities of experts like these eminent economists and compared them to the general population as represented by a sample whom they observed and a portion of the general population who are very, very good at forecasting. It turns out the civilian super forecasters systematically outpredict the experts. The general population also outpredicts the experts, but not by as astounding a percentage. How is it experts always get things wrong? Well, Tetlock has his ideas about it, and maybe we will explore those further in a later show. But let me just read the final paragraph of the Wall Street Journal article. John Mousseau of Cumberland Advisors won last year's pool and has come in first or second about half the time in the past decade. His secret: get a sense of how the group feels after a few days of conversation and fishing and go the other way, much as one would in a thoroughbred horse race. End quote. So there you go. Mr. Mousseau wins these bets and he outdoes the group by appraising the group as human beings who behave in groups, even though they are eminent economists. They cleave to certain standard explanations without re-examining them. They don't look at evidence afresh. They kind of move in step with one another, as smart and as brilliant as they are. Well, let's move on and have a conversation with somebody who's even smarter and more brilliant. We're here again, not for the first, second, or third time, but the fourth time, with Larry Swedroe, who joined the BAM Alliance 20 years ago and is its director of research. Larry has written many books by himself and many books with others, including Andrew Berkin, with whom he wrote The Incredible Shrinking Alpha and What You Can Do to Escape Its Clutches. That was published last year in 2015, and two of the early programs on Financial Poise Radio with Larry Swedroe were devoted to that highly entertaining, but also very deep and meaningful look at financial research and how it bears upon individual investors. Larry has a book coming out soon, also with Andrew Berkin, entitled Your Complete Guide to Factor-Based Investing, The Way Smart Money Invests Today. And I've read both. The style is engaging, accessible while conveying the findings and meaning of important scholarly research. You can also find Larry's occasional writings on ETF.com and mutualfunds.com, among many other places, and also on NBC, CNBC, CNN, Bloomberg Personal Finance, in addition to Financial Poise Radio. So let's get to linking this conversation with our prior conversation very briefly, picking up sort of where we left off, because the last time we spoke, Larry, we talked about a certain personal biases like overconfidence, over-precision, self-attribution bias can distort the lens through which individual investors see when they're picking stocks. Also, that the velocity of picking stocks systematically suppresses returns. And we finished by talking about beta and alpha, which are sophisticated concepts but are needed in order to measure what a given strategy for the market really yields. If you have a high risk strategy, it should be compared with the returns to be expected from a similarly high risk strategy. Might be one way to put it, but I will leave that to you because you are the expert. Would you mind discussing alpha and beta again for listeners who are hearing you for the first time?
Sure, I'll try to keep it simple here. So alpha is the performance above or below, you could have positive alpha or negative alpha, an appropriate risk-adjusted benchmark. So the simple way to think about it is if you buy junk bonds and you outperform treasury bonds, that's not alpha because they're clearly very different in terms of their risks. But if you outperform a index of junk bonds, which there is, then that would be true alpha because the benchmark is an appropriate one. So similarly, if you buy emerging market stocks, your benchmark should not be the S&P 500, but say a Vanguard emerging market index fund. Similarly, if you buy small cap or value stocks, which are riskier and have had higher returns than the S&P 500, your benchmark should then not be the S&P 500, but should be an appropriate, say, Vanguard index fund of small caps or value stocks. So what we often see are claims of alpha, which are nothing more than really exposure to beta, which is these other characteristics, whether they are junk bonds instead of safe bonds, whether they're small stocks instead of large stocks, or value stocks instead of growth stocks, or emerging market stocks instead of developed market stocks.
I guess I'd like to suggest that the terms in which you were just describing the market, which are not unorthodox terms by any means, are relatively recent in to the extent they're known by the market and accepted by the market. So we're going to take a little trip through recent history, I think. Let me just repeat the title of the book that is going to come out. It's Your Complete Guide to Factor-Based Investing, The Way Smart Money Invests Today. I like the terms smart money and the phrase invests today because what we consider to be smart money invests differently today in a systematic way because of findings that you describe step by step in that book to help give us a full perspective on what kinds of gains one can realize and how one should understand them, especially when you're paying somebody else to get them for you. And in connection with that, I note that Jack Traynor, and his last name is spelled Treynor, died just the other day. And he had a very important impact on this history in the early 60s. From the Wall Street Journal note on Jack Traynor's death, who died at 86. He was an academic on the outer margins of academia. Mr. Traynor helped pioneer the use of math to measure the risk-adjusted performance of fund managers, which we were just talking about, alpha and beta, advancing techniques that encouraged investors to embrace index funds rather than stock pickers. I also want to say that the article states that Traynor didn't bother to get a PhD, gave up a potentially lucrative career on Wall Street, and refused to use a computer, preferring to write on legal pads. So, let's start in the 60s, and we can make our way to the present day. What big steps forward were made by Traynor and his successors?
Yeah, it's unfortunate. Jack Traynor and another fellow named John Littner didn't get the credit they deserved. Most people who are familiar with academic research at least know the name William Sharpe, and Sharpe tends to get most of the credit for developing what was called the Capital Asset Pricing Model, or CAPM, and that was the first asset pricing model. It gave us the first formal definition, Chris, of the relationship between risk and expected returns. It was our first factor model. All three were working independently and came to the same conclusion at virtually the same time. But Sharpe, for whatever reason, tends to get most of the credit. So what this model said is that the risk and therefore the return of a portfolio is explained mostly by its exposure to beta. But by that they meant specifically the market beta. What do they mean by that? They meant the risk of a security or portfolio of securities relative to the risk of the overall market. So the overall market has a beta of 1. You own, as we mentioned in the previous segment, high-flying tech stocks. They're much more risky, although beta or market beta and volatility are not the same thing. For most people's purposes, it'll be close enough. You could think of them as volatility. So if your portfolio is much more volatile, maybe 1.5 times that of the market, your beta might be 1.5. So if the market gets 10%, your benchmark should be 15. If you earn 12, you actually should have been earning 15. That's the market, the appropriate benchmark. Your alpha was -3, not +2, which is your outperformance relative to a safer S&P 500 index. Conversely, if you bought defensive stocks like grocery store chains or drugstore chains or utilities, tend to be not as co-varying with the market. They're not as cyclical. They may only go up and down 70% as much as the market. So if the market goes up 10, you go up 7, that would be matching the benchmark. If you went up 8, even though you underperformed the S&P or the market, you would actually generate true alpha. Now, this was the working model for 30 years, roughly. Unfortunately, like all models, Chris, they're flawed or wrong. And academics started writing papers to show that there were problems with the model. And I'll see if I can explain this fairly simply. Let's say, Chris, that you have a portfolio of 100 stocks, and I have a portfolio of 100 different stocks. If you earn 10% and I earn 13, the difference is 3%. If we knew the betas of those two portfolios, beta would have explained 2/3 of that difference roughly. So 2/3 of that difference in returns was explained by the fact that if I got the 13 and you got 10, it was because I own stocks with higher betas. The rest of it might have been luck or skill in picking individual stocks or market timing, or it was possible it was some unknown yet factor we haven't uncovered. And so the academics were researching to see if they could uncover other factors that would eliminate the flaws in the model.
So in the early 60s, at the time of the Gidget movies, independent brains, independent minds like Jack Trainer's, could conceptualize what beta is and its relationship to alpha, and that this explained 2/3 of a given gain is the relevant beta. Well, all right, let's go from Gidget to Nirvana and Soundgarden in the early 90s. And there are some great leap forwards.
Right.
As regards these, and factors is going to be a key term throughout the rest of this discussion. Go ahead.
In the 1980s, a group of researchers started publishing papers showing that there was this size effect, they called it, a size factor, meaning small cap stocks delivered higher returns, roughly 3% a year historically, over large stocks. And that outperformance was beyond the amount explained by beta. So small stocks, as you would guess, are more volatile than large stocks, so they have higher betas, but the outperformance extended beyond that. So there was this independent factor called size. And then other researchers paying attention to Warren Buffett and Ben Graham and David Dodd as well found that there was a value effect. So stocks that had low prices relative to earnings or cash flow, sales, or their book value also outperformed. In this case, about 5% a year. And that outperformance of roughly 5% was in addition to their higher betas as well. So these stocks were riskier, more volatile, and they delivered even more than beta predicted. And then 1992, Ken French and Gene Farmer, who are often mistakenly given credit for discovering these factors, what they did was summarize the research and created a 3-factor model now. So you have market beta specifically, size and value, and this improved the explanatory power of the model to in excess of 90%. So again, if we could use your example where you earned 10 and my portfolio earned 13, that's a 3% difference. Without even knowing what stocks we own, I could predict 2.7% or so of that 3% difference. I could explain it just by the exposure to these factors. That left only 30 basis points left that could be explained by either skill, luck, or some unknown factor. And then there was some more research that showed mental was a factor.
Let's stop there with value and size. Because what you're saying is consistent with what you write, and it's consistent with what other people write. But for people who haven't been through this dance, let's talk about the intuitive nature or the intuitive aspect of size and value. I mean, value should have a very powerful intuitive aspect for people because you're buying something that seems to be underpriced. So if you buy things that are underpriced, you would expect that to the extent they gain, they will gain handsomely. Or if you buy things that are small, any gain is going to be appreciably larger than a similar gain in a large thing. And so in each case, you get a kind of premium for better performance. Am I on the right track?
With one small adjustment, you said that if you buy value stocks which are underpriced, that's not the way I would say it. You're buying stocks that have low prices, and the reason they have low prices is you may have to hold your nose to buy the stock. No one else wants to buy them because maybe they're a coal company and the administration is saying, we're going to wipe out coal stocks, or there are environmental risks, or they have a lot of financial leverage. They're highly volatile in their earnings, which means if you get a recession, these companies can go bankrupt. There are all kinds of measures that we can look at, including the risk of bankruptcy, that make these companies riskier. And obviously, smaller companies tend to also, I think intuitively, people understand that they're riskier. So those, Fama and French actually call them risk factors, and they tend to trade at lower prices because of the risk, and therefore you are compensated for taking that extra risk, not with a guaranteed higher return, but a higher expected return. But sometimes those risks show up and can do so for a long time.
But there might be another aspect, just staying with the value premium, which is what we're talking about, the higher expected return, that doesn't have to do with the intrinsic quality so much of the lower priced stocks as with the behavioral response people have to high priced stocks, which after all are high priced because they've attracted a lot of positive attention.
The way I like to think about this, there are two explanations for the value factor. For size and for stocks, everyone gets it. It's common sense. These things are clearly more risky. They should have higher expected returns. But some people hypothesize that these stocks are, as you said, these value stocks may actually be undervalued. And the research shows that it's not really that the value stocks are undervalued. It's that there's a group of stocks that are too highly valued. And if you avoid them, you'll get much better returns. Unfortunately, individual investors, mostly, those to some degree institutions as well, tend to buy these stocks. They like them. The term in the literature, and the one I like, is that they're lottery tickets. They look like a lottery in their potential distribution of returns is the term, but think about it this way. You buy a lottery ticket, we know the payout is roughly 50%, so every time you spend $1, your expected return is minus 50 cents, but you have a small chance of hitting a big home run. And so stocks that look like that, people like to play the lottery even though they know that it's a negative returning investment. So stocks that are penny stocks, IPOs, and stocks that are in bankruptcy, and these internet companies that come along with a great story and don't have any real earnings yet, but people are betting that they'll be the next Google, people tend to overpay for them, and that means that the growth stocks get lower returns than they should be because people are overpaying for them. hoping to win the lottery, and the value stocks get ignored, and the prices are therefore lower than they should be. There's these two schools of thought. Some people battle over this in the way that people fight over the Budweiser beer commercials. Is it taste better or is it lighter, less filling? My view is it's probably some of both. There are excellent academic papers showing good risk stories. There are literally more than 24 of them, but there are also papers showing this lottery effect at work. So I think it's a combination of both. It's not black or white.
Okay, but so you get a value premium from lower price stocks and you get a size premium from smaller stocks. And that helps explain takes away some of the alpha and makes it into beta in a given analysis. But those aren't the only two factors. So we have the capital asset pricing model gave us beta, and the factors of value and size are two factors. Are there other factors that have emerged? Take tiny 30 basis points.
Yeah, unfortunately, there's a zoo of factors, as John Cochran, a University of Chicago professor, coined the phrase. There are 600 factors that have been identified that have explanatory power. By that I mean papers are written claiming this. Fortunately, and that's what we show in our book, you only need to know about 5 on the equity side and 2 for bonds. So you only need 7 out of the 600 to focus on. The rest of them are irrelevant for a variety of reasons. If we have time, we could go into. But we've covered 3 of the 5 equity factors. There are 2 more. One of them is called momentum, and momentum happens to exist in not only stocks, but bonds and commodities and currencies. And your audience can think of momentum in the following way. It's the tendency for securities that have been outperforming over the last year to continue to outperform over the next short period, on average about 5 months. And those who are underperforming in the last year have a tendency to continue to underperform for a relatively short period, 4 to 5 months. That was written up by 2 researchers and a fellow named Mark Carhart in 1997. He incorporated that, and now we have either some people refer to it as the Carhart 4-factor model or the Farmer-French 4-factor model. So that's 4. And the last one is probably Warren Buffett's favorite. It's, as we discussed in the last session, it's a profitability factor, which the researchers have expanded to look beyond just highly profitable companies, but quality. So looking at companies that are not only profitable, but also have low financial leverage, stability of earnings, stability of dividends, for example. And that profitability factor is also at work. So here's roughly the data. Beta premium has been about 8%. I'm just going to round these. The size premium is about 3%. The value premium closer to 5%. Momentum has actually been the largest, about 9%. And profitability, quality is in the 4% or so range if you look at them each in isolation. So one last comment. No matter what period we look at, each of these factors tends to outperform. But the longer the horizon we look at, the tendency increases. So roughly, you could think of it this way. At 1-year horizons, each of them tends to outperform roughly 70% of the years. 3 years, it jumps to maybe 75%. At 5 years, 80%. At 10 years, 85%. And at 20 years, 90%, which means that no matter how long your horizon, you have to be prepared to accept the fact that no matter which of those factors you invest in, you will underperform. Just like from 2000 to 2009, in that period, Treasury bills probably earned about, 2 or 3%, and the stock market lost 1% a year. So the annual premium to stocks was minus 3% or worse. So you have to remember that. And so to me, the bottom line is we don't know which of these factors will outperform during any period. So what I tell people is you want to diversify your portfolio as much as you can across each of the factors. And if you build such a portfolio, no matter the horizon, the odds of your getting a premium are better than any one of the individual factors themselves.
Okay, well, let me ask you then a two-part question. First, do hedge funds and other purveyors of financial wisdom who charge people for their wisdom speak in terms of such factors? And number two, how well accepted generally is the idea that diversification of factors over a longer period of holding is of key importance?
Okay, so let's see if I can answer it with a few key points here. First of all, by the addition of these two other factors, we're now able to explain over 95% of the differences in returns of portfolios that are diversified. So going back to our 10% and 13% example, we're talking about 5% or just 15 basis points is all that's left that could be attributed either to some other factor, which can't leave much room, or skill. That is a problem because active managers charge a lot more than that 15 basis points in that example. So what the smart money is doing is moving away from active management and focusing on deciding which factors you want exposure to, you're willing and able to take those risks, and then diversifying across those factors. The language is moving towards this, although I dislike the term, it's now smart beta. And instead of diversifying, we used to talk about diversifying across asset classes like small caps and large caps and value and growth stocks. We're now adding these other factors and talking about diversifying across them as well. So you might buy a small cap value fund that also gains exposure to the profitability factor and also tries to gain exposure to momentum, all in one fund. That is the way hedge funds, try to operate. The problem for them is all these issues we discussed earlier, all that was once alpha and they deserve great credit for, but now you can't charge for it because we get to invest, and here's the best news for your listeners. You get to invest virtually identically like Warren Buffett, and as long as you have the same discipline as him and don't avoid the panic selling, in a very low-cost way through these now more sophisticated ETFs and mutual funds that are gaining exposure to these common factors.
Well, you're kind of stealing the thunder from my last question, which is if you could summarize what Warren Buffett does and how do we WWWBD, what would Warren Buffett do? And it sounds like you just answered that by investing in mutual funds or other vehicles that are not actively managed, which create exposure to appropriate array of factors.
Exactly. We advise on directly at Buckingham on $8.5 billion of assets, and in the BAM Alliance close to $27 billion. And every one of our clients is investing in diversified portfolios that gets exposure to these same characteristics or traits that Warren Buffett basically tells you he wants you to invest in, these value companies that tend to be more profitable. And then the funds also try to add a little bit of exposure as well to this, momentum factor, and we also size factor, which we can gain. Warren Buffett likes to buy the big companies because he wants to have an impact on these huge Berkshire Hathaway. Buying a little $300 million company isn't going to help him very much. But we as individuals can go out and invest in a fund that owns 600 of those different ones as well. So what I tell all our clients is you're getting to invest in a very low-cost manner in the way that the smartest investors in the world are doing. And you don't have to spend 1 second of your time analyzing stocks trying to pick them, time the market, just let the market do what it does for you. And through screening for these metrics, you will get similar results.
But it's important also to have the appropriate temperament.
That's the key. Because to be a truly passive investor, not only do the funds that you invest in have to be passive, but you have to be passive. And as I point out in my book, Think, Act, and Invest Like Warren Buffett, Buffett warns you never to try to time the market. But if you're going to do so and ignore his advice, at least be a buyer when everyone else is panic selling. And that's in effect what we do as advisors. We get our clients to buy when everyone else is panic selling, not because we're making any prediction, but we're simply rebalancing our portfolios. So if a client was 60% stocks and the bear market drives it down to 50%, we need to buy to restore the portfolio to its proper asset allocation. So always buying after periods of bad performance, when valuations are lower and expected returns are higher, that's when Buffett likes to buy, and we're selling in the reverse situation.
Well, Larry Swedroe, really appreciate you introducing our audience to the, well, it's not a miracle of factors, but it is a late-stage intellectual outgrowth, starting with Mr. Trainer and others, and continuing to this day to explain a great deal of where the profit comes from in investing. It's quite an exciting story. Too bad that it's nearly over, it seems. We really appreciate you unpacking that for us. Thank you.
My pleasure, Chris. Glad to come back anytime.
That was Larry Swedroe, Director of Research of the BAM Alliance. He and Andrew Berkin co-authored The Incredible Shrinking Alpha and What You Can Do to Escape Its Clutches, published last year. And another book is In the Hopper. This has been Financial Poise Radio. I am Christopher Cole. Financial Poise Radio is produced by Stephanie Strait. We thank you all for listening. Please, let's do this again sometime soon.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.financialpoise.com. Each week, Financial Poise Radio brings you news and education about finance, investing, business, and law. To see a short written summary of this episode, go to www.financialpoise.com. Financial Poise Radio is a production of Financial Poise Radio Productions, LLC.